Okay, in this video, we're going to be talking about order blocks, another very popular concept within the SMC library. So let's go over it. Let's break it down. So the order block, put simply, the order block is going to be the last bearish candle or last series of bearish candles prior to a shift in market structure. Okay. Now, a common misconception about the order block is it has to be one candle. It does not have to be one candle. We're going to use one candle for this example, but I'll also be going over a few other examples as well. I'm going to tell you how to find the best order blocks, the absolute highest probability order blocks we're going to go over in this video. All right, so we've gone over in the market structure series. In the market structure series, we've gone over what a shift in market structure is. We all know what a shift in market structure is. Right here, look at my cursor, look where it's moving. See how we got that big surge up right there, cracking those highs? We can all agree that that is a shift in market structure. It broke those highs, and not only is it a shift in market structure, but it is a high probability shift in market structure. Why? Because of how price closed above the levels, because it has the fair value gap confirmation. All that makes it a high probability shift. Okay, what I'm going to do is I'm going to note this because this is important as well. It's important in regards to high probability shifts because we went that fair value gap confirmation for a high probability shift, but it's also important with order blocks. That isn't really talked about that much. You don't hear a lot of people talk about it, but it's very, very important whenever you're choosing your order blocks. It's not 100% necessary, but if you want your best to the best levels, we need to consider the fair value gap. Okay, this is our order block right here. See this down close candle? We're going to mark it. So here's how I kind of want you to think about it. This is the best way I think to think about order blocks. Big money. All right, let's look at it like this. Big money. Big money wants the best price they can get. They don't want to overpay. They want bargain prices. Prior to that shift in market structure, what was the best price you could get? Well, the best price you could get was that last down close period prior to the shift. Because you can see right in here, this is basically where the selling originated at. This is where it originated at. This is where that selling originated at. It came down, and then you get a shift. Does smart money, do they want to be buying as something is just, ripping up to the moon? No, they want to be buying. They want to be accumulated positions when price is not, when it doesn't look as favorable. Because once it looks favorable, it's usually no longer cheap. It's no longer at a bargain price. So that's why the down close candle, this is where it originated at. This is basically where this move originated at. This was the last best price. This series of down close, this down close candle right here was the last best price that you could have got prior to the shift. All of this selling in here, this is an entire day of selling where smart money was able to get bargain prices before that shift. So it was down here, it was cheap. It's in a discount. It's cheap. They're getting their positions, and then boom, we get a shift with our fair value gap confirmation. With having such an explosive move like this, and this was only one day, smart money, they aren't going to get all of the positions in that they want to get in. They're not going to be able to get everything filled that they want to get filled. And this area of price right here is not efficiently delivered. It's an imbalance. Where do you think smart money will want to add to their position whenever price retraces? Where do you think you want to wait on? You want to wait on the area where that move originated at. This is where it originated at. This is where you would get your best prices. Now, here's another thing you want to see for order blocks. Your order blocks, your bullish order blocks will be in a discount marketplace. So what is a discount marketplace? We went over discount and premium before, and also in the video description, I'm going to leave a few links in the video description. I'm going to leave a link to a video that I did on a premium and discount marketplace, maybe a few videos. And I'm also going to leave a link to my fair value gap videos. Both are essential to whenever we're using order blocks. So let's measure this price range. What you'll do is you'll take the most recent low prior to the shift in market structure to the high, and you're going to measure that price range. And what you're going to do next is you want to look, because your order blocks, typically they're going to be, more times than not, they're going to be in a discount marketplace. They're going to be below 50% equilibrium of that price range. So you can see right here, look at my cursor, look where it's moving. There's 50% equilibrium of that price range. And right below 50% equilibrium, we have our bullish order block right there. That down close candle, that last down close candle prior to the shift in market structure. Again, you want to look for that last down close candle or last series of down close candles prior to the shift in market structure, okay? And it'll be in a discount marketplace, so below 50% equilibrium of the price range. Also, for the best order blocks, there's a few other things you want to look for. By having the fair value gap confirmation, that imbalance, again, 1, 2, 3, we got a fair value gap right there. By having that and by having your order block nested inside of that imbalance, it makes it so much more powerful whenever you have that criteria. Whenever you have the order block nested inside of a fair value gap like this, way more powerful. So it's best if you got that as well. And lastly, it's best if it takes previous liquidity. So you see right here how we had a swing low level right here. Look at my cursor. And you see how the last move lower prior to the shift to grab that liquidity. So basically we grab those sell stops. There was a big bucket of sell stops right here. We grabbed those sell stops, meaning we had willing sellers right here at a lower price. What does smart money do? They collect those orders and they send it higher, okay? What's the next best price? After you get that shift in market structure, you now have that imbalance in here. The likelihood of it returning down to this level isn't likely now because we now have had a shift in market structure. What's the best next price? The best next price is going to be in a discount marketplace, and in a discount marketplace, we got our bullish order block. That is where smart money is going to want to add their positions, okay? And for the order blocks, I do use the bodies of the candles because you might be wondering, well, the top of this candle, it's in a premium. It's not in a discount. So you go with using your order blocks, go with the body of the candle for the best results, okay? Because that's where the bulk of the volume is traded. That's why you do it. That's where the bulk of the volume is traded. That's where you're going to get the best follow through. So yeah, sum it up again, the order block is going to be the last the bullish order block in this case is going to be the last bearish candle or last series of bearish candles, because remember, it can be more than one candle. What's important though is that it's in a discount marketplace. That's what's important. And it's the last, so it's the last bearish candle or last series of bearish candles prior to a shift in market structure. They need to be in a discount for the best results. They need to be taking previous liquidity, a significant liquidity pool. It needs to be nested inside of an imbalance. And if you have that criteria, you have a high probability trade or a high probability level at your disposal if you have that criteria. All right, now I'm going to show you an example on an intraday chart because like it's the same exact thing. It's the same exact signatures on a daily as it is an intraday chart. You want to see basically the same exact stuff. So I'm going to pull up this gold from this morning. See these two up close candles. So we went over a bullish order block in the previous example on the daily chart, but now we're going over a bearish order block. Okay, so the bullish order block, you'll have down close bearish candles prior to the shift. For the bearish order block, you'll have up close candles prior to the shift, okay? Because this was the best possible price you could have got. Look at my cursor, look where it's moving. These two up close candles. This was the best possible price that you could have got prior to that shift in market structure. That's what it is in simplest terms. It's the best price that you were able to get, that smart money was able to get prior to lower prices. So then, once price retraces within that range, smart money is going to want to get more orders filled at this particular area where it originated at, because this is where that Judas swing originated at. And that's another important note point is we went over the Judas swing, but these order blocks, a lot of times they'll be from Judas swings. So like you'll have like Judas swings during the London session that'll grab liquidity like this. This is a very common signature that you'll see. It'll be like you'll have that Judas swing during London session to take liquidity, and then you'll have it pull the rug. And then coming into New York session, you'll have the opportunity to get on board that trend to piggyback that momentum off of that bullish order or off of that bearish order block. So a lot of times these order blocks are created as a result of the Judas swing when we're dealing with when we're dealing with intraday charts here. But yeah, so we got the criteria. This was a shift in market structure. We have the fair value gap confirmation. See how we got 3 candles right there, making the fair value gap. 1, 2, 3 candles. And also note how the order block, remember both of these candles are order blocks. 1, 2, both of those candles are order blocks. Note how that order block is nested inside of the fair value gap imbalance. It's nested inside of it, making it a very sensitive price point. So we had the fair value gap. We have the order block nested inside of the fair value gap. We have the order block grabbing liquidity, which is key as well. See how we got a swing high level right here? Look at my cursor, look where it's moving. So price was like trending lower. It was trending lower, trending lower, trending lower, trending lower, trending lower. And then right here into London kill zone, we had a surge up higher. aka our Judas swing. That's our Judas swing higher to take liquidity. Okay, but it's also essential to the order block. We want to see that order block take previous liquidity prior to the shift in market structure. So it took that liquidity, has a shift in market structure. These series of up close candles were the last best possible price that short sellers could have got their entries at prior to the shift. So whenever price returns up into that area, smart money, big money, they're going to want to get more orders filled. They're going to want to get more orders filled at that area because that was the best possible price they could have got. So that's why you'll get really good reversal points off these order blocks, because it's the best possible price. This is where that move originated at. That is where that up move originated at prior to the shift. The best possible price prior to the change in direction, prior to the change in trend. Making sense? So that's what you want. And then remember, is it in a premium marketplace? Will we take the high of that liquidity run, or the high prior to the shift to the low? Did it give us a premium marketplace? Yes, it did. Look at my cursor. There's 50% equilibrium. See how it popped up above 50% equilibrium? Tested that order block in a premium marketplace, respected that level, and now it's selling off. So just a really clean, that's a high probability order block. That's a high probability order block. Has everything you want on it. A clear representation right there of a order block that has everything you want. The fair value gap. The order block is nested inside the fair value gap. It's taking previous liquidity. It's in a premium marketplace. That's what you want. Okay, so one last time, the order block, a bullish order block is the last bearish candle or last series of bearish candles. It can be either prior to a shift in market structure. Okay, because essentially the market structure shift is what? It's what, guys? It's a change in trend. So you're getting the best possible price at that order block. Okay, on the retracement. It's the last series or last candle prior to a change in trend in the simplest terms. The bearish order block is the last up close candles or last series of up close candles prior to a shift in market structure, prior to the change in trend. And that's what you're looking for.